Hello friends, welcome to Learn Easy. We will discuss sustainable finance and ESG. Sustainable finance includes the integration of environmental, social and governance ESG considerations into financial services and investment decisions. The growth of sustainable finance has been supported by regulatory push, investor pressure and social demand. Governments across the globe are becoming more stringent with sustainability regulations, whereas investors are increasingly requiring more transparency on ESG performance. With social issues like climate change, social inequality, and corporate governance on the rise, ESG factors are no longer optional but a necessity for long-term financial viability and competitiveness. Increasingly over the past few years, more and more attention has been given to ESG-oriented companies by consumers, regulators, and investors. ESG refers to environmental, social, and governance. It is a structure used by investors as well as companies to analyze corporate behavior and its effect on society. Key drivers of ESG growth are: first, investor demand. Institutional investors such as pension funds and asset managers are investing in ESG compliant firms. Second, regulatory frameworks. Governments are adopting regulations like Sustainable Finance Disclosure Regulation (SFDR) to provide more ESG transparency. Third, consumer influence. Today's consumers prefer sustainable and ethical business practices which shape corporate behavior. Let us see how ESG investing works. One request: if you are new to my channel, please subscribe, share and press the notification bell. ESG investing typically involves a thorough analysis of potential investment using ESG criteria. This process includes research and data collection, gathering ESG data from various sources including company reports, third-party ratings and independent research, scoring and ranking. Assign scores to companies based on the ESG performance and rank them accordingly. Portfolio construction. Building a diversified portfolio that aligns with ESG goals, often using a mix of positive screening, ESG integration and thematic investment, etc. Active ownership. Engaging with companies to improve ESG practices through dialogue, voting on shareholder resolutions and advocacy. Let us discuss the types of ESG investing. The main types of ESG investing are: first, negative screening; second, positive screening; third, ESG integration; fourth, thematic investing; fifth, impact investing; and sixth, shareholder advocacy. Let us elaborate each type of ESG investing. First, negative screening. Objective of negative screening is to avoid supporting activities that are considered harmful or unethical. Negative screening involves excluding companies or entire industries from investment portfolios based on specific ESG criteria. As for example, excluding tobacco companies, fossil fuel producers, weapon manufacturers, or businesses involved in child labor. Second, positive screening. Objective is to support and benefit from the companies that lead in sustainability and social responsibility. This approach identifies and includes companies that demonstrate strong ESG practices and positive impacts. As for example, investing in companies with high environmental standards, strong community engagement, excellent employee relations, or robust governance practices. One request: if you are new to my channel, please subscribe, share, and press the notification bell. Third, ESG integration. Its objective is to enhance investment analysis by recognizing the financial materiality of ESG factors. ESG integration is the process of systematically including ESG factors into financial analysis and investment decisions. As for example, assessing how a company's environmental practices might affect its long-term profitability or how governance issues impact its risk profile. Fourth, thematic investing. Its objective is to increase the growth potential of sectors addressing significant ESG challenges. Thematic investing targets investments in specific themes or sectors that align with particular ESG objectives. As for example, investing in renewable energy, clean technology, sustainable agriculture, or social housing. Fifth, impact investing. Its objective is to contribute to social and environmental improvements while earning a financial returns. Impact investing generates a measurable social or environmental impact alongside financial returns. As for example, investing in microfinance institutions, affordable healthcare, education initiatives, or companies providing clean water solutions. Sixth, shareholder advocacy. Its objective is to drive positive change within companies through active engagement and influence. Shareholder advocacy involves using the power of ownership to influence corporate behavior. As for example, filing shareholder resolutions to improve transparency on climate risks, advocating for more diverse boards, or pushing for better labor practices. Let us discuss how to build an ESG-aligned global investment strategy. Here is a step-by-step guide how investors and businesses implement ESG principles effective worldwide. First, assess ESG risks and opportunities. Evaluate exposure to climate risks, labor standards, and governance practices across markets. Second, choose the right instruments. Consider green bonds, ESG mutual funds, or sustainability-linked loans. Third, set measurable goals. Define performance indicators as, for example, carbon emission reduction, diversity targets, etc. Fourth, ensure compliance with global standards. Align with frameworks like the EU taxonomy, GRI standards, or UN principles for responsible investment. Fifth, monitor and report. Use AI-driven ESG analytics and transparent reporting to track impact and maintain investor trust. Now, we should know the benefits of ESG investment for global markets. Benefits of ESG investment for global markets are: first, stability. Protects portfolios from environmental and social risks. Second, growth. Expands into new sectors like renewable energy, sustainable agriculture, and green mobility. Third, reputation and trust. Investing in ESG compliant companies can enhance an investor's reputation and build trust among stakeholders. Fourth, positive impact. ESG investing supports companies that contribute to sustainable development and social well-being. Fifth, risk management. ESG investing can help identify and mitigate risks related to environmental, social and governance issues. Sixth, long-term returns. Companies with strong ESG practices often have better long-term success and resilience. However, there are some risks of ESG investing. Risks of ESG investing. First, data inconsistency. ESG data can be inconsistent and challenging to compare across companies and industries. Second, greenwashing. Some companies may falsely present themselves as ESG friendly without making significant changes. Third, performance trade-offs. There may be concerns about whether ESG investing compromises financial returns, although evidence on this is mixed. Fourth, regulatory risks. Changes in regulations and policies related to ESG can impact investment. Let us now discuss some corporations which have integrated ESG. Big corporations can set examples for smaller businesses on the way through which ESG principles can be added to daily business functioning. First, GovEVA, AI-powered ESG management and reporting platform. GovEVA provide ESG solutions to companies and assist in providing ways to achieve goals and comply with the laid-down ESG standards. Second, Tata Group. The Tatas are well known for their philanthropic work and show a strong commitment to social responsibility and sustainability. Third, Infosys. Infosys, India's top IT service company, has prioritized sustainability, social responsibility, and good governance. Fourth, Mahindra Group. Its practices mainly focus on renewable energy, community building, and water conservation. Fifth, IKEA. The Swedish furniture retailer has made significant changes in its work procedures to incorporate ESG for a better future. Sixth, Apple Inc. It has pledged to be carbon neutral by 2030, minimizing its carbon footprint throughout in its supply chain. Seventh, Unilever. It has integrated its business models with ESG by encouraging sustainable purchasing and minimizing plastic pollution. Eighth, Tesla. It dominates the electric vehicle market and, apart from that, forges the way to cleaner energy globally. Let us conclude now. ESG investing represents a shift towards integrating ethical, environmental, and social considerations into financial decisions. While it offers significant benefits, including risk management and positive impact, it also comes with challenges such as data inconsistency and potential greenwashing. As ESG investing continues to evolve, it provides a pathway for investors to contribute to a more sustainable and equitable world. That's all. Thank you so much for watching the video.